Hello and a warm welcome to a brand new episode of ET Markets Money Talk right here on ET Markets live stream, your own destination to get all wealth related news and be a part of discussions that matter. My name is Deepika Dhanda Singh and today we have with us a very special guest, Mr. Kshitij Mahajan. He has more than 20 years of experience in the financial markets. He's the managing partner and CEO of Complete Circle Capital, a flagship wealth management company that offers innovative solutions to match the unique needs of portfolio management services. He's a fitness enthusiast passionate about running and cycling activities, inspiring generations on and off the screen. Today, we will talk about types of portfolio management and how to select a portfolio or portfolio manager. To answer all our questions, I welcome Mr. Kshitij Mahajan.
Thank you, Deepika. Always a pleasure to be with you on this show.
Thank you for being a part of the show, Kshitij. To begin with, let me ask you, what are the different styles of portfolio management? And can you explain all of these individually?
Yeah. So, first of all, a very warm welcome to everyone, and thanks for joining in. And when me and Deepika were discussing about that, how we can, take this journey forward. Like we've been talking about various aspects of investing. Then, once you zero down on that, yes, you need an inflation-beating return, and whether you want to do it yourself, last episode, or you want some expert advice. Then we thought of that, let's zero down on what type of different portfolios and how you can select your portfolio manager. So yes, Deepika, there are four different style of portfolio management. One is obviously there's the active portfolio management, which is like your active mutual fund, which gets the benefit of how the market is moving, and in addition to the benefit of actively management by a fund manager who's very well versed about what is happening in markets, who has a team of research analysts who's covering all the business companies, and then he's selecting his own businesses depending on the fund ecosystem. That's called your active management. Second is your passive management, which has a broader portfolio globally, not in India, because globally markets are much more evolved, like in US and other markets which are developed economies, wherein they rather than just looking at doing a smart allocation, they will participate into an index itself, like Nasdaq 100 or let's say S&P 500 US index. They participate into these index, and that's called a passive style of portfolio management, wherein you, rather than going for active management, you participate in the index in itself. Just to give a figure, Deepika, in US, 89% of funds in the last 15 years are not able to beat index, and they're, let's say they're subsequent index, because every fund has a different index to pair out. So that's called a passive management. Then you have discretionary and non-discretionary management style or portfolio, which basically falls into a PMS category, portfolio management service category, wherein discretionary means that the discretion is of a fund manager what to buy and what not to buy. Let's say if it's my PMS, Complete Circle PMS, then I will take a call on behalf of client where he gives the power of attorney to me to buy portfolio for him, and I will, depending on my research team and depending on my own conviction in various businesses and our own studies, we will buy a portfolio for you. And then we will allow this portfolio to grow. And this is not a trading portfolio, it's long-term investing discretionary portfolio. This is called, the discretion is with the fund manager. Another fourth style is your non-discretionary portfolio management, wherein, interestingly, whatever I buy as per the regulation, I will take a buy or go ahead from a client. Let's say, Deepika, you're my client, and I want to buy X or Y companies in my business portfolio. Or let's say a ETF or index fund I want to buy in my portfolio. I will discuss with you, and after you go ahead only, I will buy that. That's called non-discretionary portfolio, wherein a client has a say to buy what and what not. And this becomes very important for many of the auditor, or let's say people at senior levels, because at their level they can't invest into their own companies, or they can't invest into businesses which they are evaluating. So non-discretionary is coming up very fast nowadays.
All right, thanks for telling us about the four different styles of portfolio management. Coming to the next question, how can individual investors select the portfolio management style that will suit their requirements?
So as we discussed last time that whether you want to do it yourself or you want to have a fund manager, when you decide a fund manager, or let's say you decide that you want to invest, that decision also works on a lot of things. Let's your goal planning, and then let's say for example the time horizon for which you want to invest, risk appetite. Now somebody who say that I don't want to take risk, I just want that I can get a better tax efficient return vis-a-vis my FD, then fixed income is one style. Or let's say what type of return expectation you have from portfolio. So a lot of things it depends on. So client can, depending on his all these factors, he can carve out a portfolio of 4 5 different funds, and he can select funds as per this given frame of work.
All right. While selecting a fund manager, what are the key factors that need to be considered?
So, so this is the most important point. We select fund, but what we should do is we always select a fund manager. It's like when you go to horse race, normally you bet on a jockey. Yes, you bet on a horse, but the jockey is the one who's actually riding that horse. So it becomes very important for people, and it's not that difficult also, because if you see, like, there are very simple steps which one has to follow while selecting a fund manager, because eventually your fund has to be managed by that fund manager only. First thing, the most important point which I see while selecting a fund manager is the compliance angle, the risk matrix, or the investment philosophy which fund manager is taking. Now, if his investment philosophy is very aggressive and you are a conservative client, then you should not get in line with or get along with that fund manager. So that's the first point. Second most important point is the leadership quality, because he's the one who has to define what to buy and what not to buy, and he's not getting influenced by any of the ideas of any given, let's say, company official or any given distributor channel partner. So that leadership quality will play a very very critical and important role. Uh, if one define its risk matrix properly, third part is, I said, investment philosophy, leadership quality, risk matrix properly, it again becomes very important. Like, you have defined that I will buy this, I will buy this, I will buy this. And if you are in line with what investment philosophy or risk parameter which you have taken into account, then I think that's the right approach which you are taking. Fourth is the longevity of the fund manager. Let's say we say that by the investment investor behavior gap is there in terms of the returns which investor is generating and the fund is generating. Similarly, if the fund manager is there for long with the fund, then your conviction and your confidence build in that fund and as well as the fund manager. Because if he's not in a hurry to leave a company or to leave a fund, then it gives a very positive sign to you that yes, you can get along and get in line with this type of fund manager. Fifth, the most important point is that when you shortlist a fund manager, then you should look at his churn ratio in the portfolio also. It gives you again an indication that how much confidence and how much longevity he has in his ideas of buying a portfolio. And it's very much available. Churn ratio is available in all the fact sheet for all the funds that's been regulated by SEBI, and one has to mention that. And last part, obviously, the return part. So yes, the problem which in our system is that all the funds which you want to compare, they will only show the comparison first basis on the return part, and then you have other parameters coming. Return is important, but return is the outcome of all these processes which we are bringing in. But yes, return is also important. You say everything is fine and Kshitij is talking all this, for return to ban nahi raha hai. So return be important hai. But I'm saying consistency of return is important rather than just peeking out of that return is important. Look, you just need 13 14% compounding in your portfolios. And somebody is saying somebody is giving 18 19%. I'm saying very good. That guy must be a good guy. But whether he's consistent about that return or not, and in equity consistency is not there. One year will make minus 20, other year will make 40. But yes, if drawdowns are less when market is falling, you are falling less, and you are tactically changing the portfolio depending on how the market is behaving in falls, then that's the right approach. I think what is more important is that drawdowns are less as well as volatility is less in the portfolio. So all these factors become very important. Return is the outcome of whatever we are discussing.
All right, now before we sort of go ahead with our conversation, I request all of you who are watching the stream right now, do hit the like button, follow Kshitij on our page, and if you have any questions, do ask Kshitij. He's going to answer all your questions. Now, coming to my next question, how can investors evaluate fund managers' performance?
Yes, so again, the outcome of what we discussed in the last question will come here. A fund manager performance has to do with the consistency rather than just outperforming the index only. But yes, the most important point is whenever we evaluate a fund manager performance, you have to subtract uh, uh, the uh, 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 the risk-free return, which is like a 10-year GSEC in India is 7.5, and you are investing into equity markets. So if you are not able to beat the risk-free return with a good delta, then it's of no use in investing into that fund, irrespective of whatever good things you're doing in the fund. So let's say a fund is generating 11% or 12% return, and risk-free return right now is 7.5, which is a 10-year GSEC return. Then the actual return minus the risk-free return, which because you are taking a risk while you're investing into equity, is 4.5%. And then you compare the same part with the comparative index because you need the benchmark for each and every fund. So let's say any large cap will have a Nifty 50. Now you compare with Nifty 50 minus the risk-free return and what type of delta it has created from there. So rather than looking at what other funds are doing, you should be looking at your fund vis-a-vis the benchmark. Yes, you should evaluate other fund managers also, but believe me, give some time to your fund. So consistency of return, you should be able to beat the risk-free return with a good delta. Second part. Third most important point is that drawdowns are very less. Like drawdown means that whenever markets are falling, if you are falling in line with the market, still okay. I'm saying, but if you're falling more, then there is a question mark. I'm saying, but yes, try to fall less. And the fourth most important point is how you are shaping up or how you are performing vis-a-vis your peer group. Let's say if you are a multi-cap fund, how other multi-caps are doing. And I'm not saying that you have to be in top quartile. Again, that's not the question. Question is that are you giving return with a less risk? And if you're giving a little less return, then still it's okay. But if you're taking more risk and give a return, then it's a big question mark because that risk comes at a price. So I'm saying I really like those fund managers or fund houses which actually look at giving risk adjusted return, or I say that sleep adjusted return. You should not lose your sleep over returns. Investment is to give you a good and sound sleep, not to give a sleepless night to you. So there are a few parameters one should look at while evaluating a fund manager.
And Kshitij, is looking at past performance a good idea?
So although you don't look at rear mirror while evaluating a fund, but yes, it is important. But believe me, nowadays softwares and various websites are available. My suggestion to most of the clients, what we do, we are portfolio managers, but we have a wealth management boutique house also. We evaluate the top 10 holdings for all the funds, which is like 60-70% of the constituents of the portfolio, for their expected earning numbers in next 3 years, or let's say expected ROE plus in next 3 years. So you have, while you're investing into a fund, you look at what is going to happen in future rather than just looking at what has happened in the past. But past performance will give you a rough idea that how the fund manager or the fund has been performing while managing this fund over the last 3 to 5 years. But yes, short-term performance should not be looked at. But yes, long-term performance should be looked at, and that should be one of the criteria while selecting a fund. Because yes, what you are looking at is that how this fund has performed, how the guy has done well. And again, I'm saying he doesn't have to be 1, 2, 3, or 4 or 5 position in terms of his or her ranking. What is more important to do is that with less amount of risk, is he able to beat the benchmark, or is he able to beat the risk-free return with a good delta? I think if he's able to do that, then I think more or less things are in line. So past performance has to look at, but yes, as one of the constituents, not in overall scheme of things.
All right, we have a couple of questions coming in from our viewers, Kshitij. Deepak Rastogi wants to know, which small case funds can you recommend?
So Deepak ji, I will not be in a situation to recommend any small case fund because I don't track small case funds. I'm saying if you have let's say small amount to invest from your side, then better look at mutual fund. That's a right way of doing things because small case will give you a portfolio to replicate, and you will replicate that portfolio in your personal capacity. But when the holding is with you and not with the fund manager, then likelihood of you taking an action on it is much more than rather than somebody other or someone who specialized in this field is managing money. So I'm saying that they can just give you the allocation on what stocks they are buying, but eventually the portfolio is lying in your demat. So rather than that, just look at a couple of multi-cap funds, mutual funds I'm talking about, and that will help you. But there are good names like Sunil Singhania and many other good names who have small case offerings also. But I don't track it, so I am not able to recommend you. But I can only recommend you that the way you can create wealth is by investing into small amounts into mutual fund. If you have extra money, then look at a couple of good PMSs in which you can invest.
All right, Deepak, I hope your query has been solved. Coming to Somnath's query, he wants to know, should we buy Titan Company?
So there's no recommendation, but it's an amazing franchise, believe me, And when you want to buy Titan, just don't buy Titan for making money out of it. Just buy Titan for being a shareholder of Titan and creating a long-term wealth for yourself. It's a great franchise. And not only its jewelry part, its watches part is doing well, but otherwise, overall, the franchise has come up really well, and they are venturing into many other asset classes also. So you should look at that company. Again, there is no recommendation. This is my liking. So you do your research at your end. But yes, I like the franchise very well.
Weber wants to know, is TNPL good to keep?
Which company?
TNPL. SolarWinds.
SolarWinds.
Yeah.
If you're asking about the SolarWinds, TNPL, I don't know. But if you're about the SolarWinds, I'm saying India is less than 1% penetration in overall liquor consumption in wine. So, we have a long journey to go before the actual consumption will start. Although they have their in-house 59 brands which they are marketing, and there are 20 countries in which they are exporting, but it's a long way from here. Sure, it's a good stock, but there are better stocks. I'm saying that. So somehow it's on a tracker, but I think it will take some time to shape up.
So I hope all your queries are solved. Now coming back to my questions and getting to the last one, it's basically about the importance of a fund manager in a fund house. So what do you think is the importance?
So I will say it like this, that eventually when you invest in a fund, it's been managed by the fund manager with his team of research analysts and junior fund managers, or let's say a CIO who's guiding everyone. So he's the key component of this entire ecosystem of fund house. Because end of the day, it's not only fund manager, but I'm saying the entire fund management team is the key component. They are the one who have decided that we are going to have this fund in this shape and we are going to manage like this. So I think he's the most, or let's say as a team, fund management team is there. It's the most important component of overall asset management system. And one should do due diligence on the team. Normally what we do is we do due diligence on the company, but it's very important that your funds being collected by some, let's say some sales guy, XYZ person, or someone like some operation guy who's processing it. Every system, every person is important, but the key component of fund management is the fund manager and his team. So one should actually we don't look at the profile of fund managers. We just look at past performance and how it's been doing. One should look at a profile of fund manager also, because it becomes evident and very important that how things are working. In fact, Deepika, normally when you apply for a license, let's say for applying for a portfolio management license, it's on the vintage of fund manager you get a license, not on the vintage of a company you get a license. SEBI also knows that yes, if the person who's going to manage the fund has a relevant experience or not, so you get a license on the vintage of that or on the experience of that. So yes, they as a team, fund management team is the most important criteria for you. And at the same time, pick and choose 4 or 5 different style of fund managers in your portfolio, and just park for long term. That is the most important point. First biggest risk when you are not investing and you're just talking about this. Second biggest risk is that when you're not diversifying, and third biggest risk when you are short term. In investing, if you take care of these three things, believe me, worst of the worst mutual funds. I'm not talking about small case fund. I'm talking about mutual funds. Let's say average performance of mutual fund is also 11-12% compounding over the last 15-20 years. So just be rest assured. Important is you to be there and investing there and creating a wealth for yourself.
All right, Rahul Chaudhary is basically confused on the three stocks. He wants to know, should we buy Angel One or Voltas?
So again, everybody who's listening, there's no recommendation. I like Voltas more, and obvious reason, penetration of AC is not even 6% in our country. Vis-a-vis China, we always compare ourselves. It's in excess of 53% now, and if it double, also the scope for all the AC manufacturers will increase. At the same time, Voltas is not only present in India, but it's doing cooling and ducting part for many of the good buildings across globe. Dubai is one of the key area where they are working very well. So if you ask me, I'm more pro towards Voltas.
All right. I hope your query has been solved, Rahul. On that note, thank you so much for your time, Kshitij. Well, that's all for now, but do stay logged on to ET Markets Live